Do you know what is powering this entire studio? Electricity, yes, but what's carrying that electricity to every light, every camera, or every screen you're watching this on? Wires and cables. And not just this studio. Every home, every factory, every metro line, every solar farm, every data center, all of it is powered and connected by wires and cables. Now, why is it interesting for investors? Because in the last 5 years, this stock went up for 60%. This one went up 700% and this one went up 2000%. This is the wires and cables business, just copper, insulation and cables. Now here's what makes this even more interesting. Wires and cables are supposed to be a commodity business, which usually means low margins, brutal competition, no pricing power and slow growth. But this industry completely flipped that script and we will see how. We'll break down exactly where this industry stands today, how the biggest stocks performed, where future growth is coming from and why giants like Adani and Birla are suddenly rushing to enter this space. So stay with me till the end. Because this industry might be entering a completely different league now and so could you. Okay, now before we get into the stocks, let's quickly understand the broader picture. Wires handle smaller, simpler electrical needs, think home and buildings, while cables are the heavy-duty version built for power grids, factories, railways, data centers and large infrastructure. And if you look at where the money comes from in this industry, housing wires lead at nearly 30% of revenue, power cables at around 27%, with industrial, flexible and communication cables making up the rest. Now, this industry has historically grown at 1.5 times India's GDP for years. And going forward, it is expected to grow at 1.5 to 2 times the GDP, which basically means as long as India grows, this industry grows faster than India. Power infrastructure, renewable energy, real estate, EVs, railways, metros, data centers, defense, almost every large theme in India eventually needs wires and cables. That's why this business commands better margins and better multiples than your typical commodity business. Alright, so who are the key listed players here in this space? Polycab, KEI Industries, RR Kabel, Apar Industries, Finolex Cables and Havels. Now interestingly, almost all of them sell broadly similar products. Housing wires, power cables, industrial cables, flexible cables and communication cables. But each company has carved out its own stronghold. RR Kabel built dominance in housing wires and the retail market, the B2C play. KEI Industries became a powerhouse in high tension and extra high voltage institutional cables, the heavy duty B2B play. Finolex built a strong retail presence in electrical and communication cables. Apar Industries went deep into specialty and high-performance cables, railway, solar, defense, niche industrial. And Polycab just scaled across everything to become the clear market leader. For the rest of the video, we are going to focus on the 3 biggest names driving this space right now, which is Polycab, KEI and RR Kabel, because their latest results tell us a lot about where this industry is actually headed. So let's get right into it. Let's start with the market leader, Polycab. The company just reported its highest ever quarterly and yearly revenue, EBITDA and profit. FY26 revenue crossed 28,500 crore, PAT crossed 2,700 crore and margins stayed close to 9.5%. But honestly, the most interesting number isn't the revenue, it's the market share. Polycab's share in the organized wires and cables market jumped from roughly 26 to 27% last year to nearly 30 to 31% this year. And if you zoom out further, back in FY19, Polycab's market share was around 18%. From 18% to 31% in a few years, that's dominance being built in real time. Now, and this is important, when you're analyzing wires and cables companies, don't just look at revenue growth. Here's why. Because wires and cables are heavily linked to copper and aluminium prices. When raw material prices rise, revenues automatically move up too, even if the company isn't actually selling more products. So the real metric to track is volume growth. Volume tells you actual demand on the ground, more homes getting wired, more factories expanding, more infrastructure getting built. Now, despite a challenging environment, Polycab still reported positive volume growth, low single digits, which shows the underlying demand remains healthy. Now let's look at KEI Industries. Q4 revenue grew nearly 19% year-on-year to around 3,500 crore. EBITDA grew over 25%, margins improved to above 12%. And PAT also grew more than 25%. So solid execution across the board. Volume growth for this quarter came in close to 2%, which means KEI sold 2% more wires and cables than last year, even amid commodity volatility and a high base. Not spectacular but steady. And then there is RR Kabel, a company that quietly delivered one of its strongest years ever. FY26 revenue grew nearly 28% to around 9,700 crore. EBITDA jumped more than 60% and PAT grew close to 58%, showing massive operating leverage in the business. But the headline number here is the volume growth of nearly 10% for the full year. In this industry, 10% volume growth is exceptional. It means the company sold 10% more wires and cables than the previous year. That shows genuine demand growth, not just commodity price inflation. Now, RR Kabel also has an FMEG business, which means fans, switches, and appliances. That segment is still loss-making as the company is aggressively investing in distribution and brand building. So right now, the wires and cable segment is the profit engine, while the FMEG is still in the investment phase. That's something to keep watching. Now, there's something that's absolutely critical to understand about this business. Nearly 55 to 70% of total costs come from just two commodities, copper and aluminium. And over the last 1 year alone, copper prices surged nearly 35%, aluminium jumped almost 50%. And it didn't stop there. PVC, the material used for insulation and outer sheathing, saw prices spike nearly 60 to 80% within just the first 2 weeks of March. Why? Because PVC is derived from crude oil and crude oil went haywire during the geopolitical tensions in West Asia. So when commodity prices swing this violently, how do these companies protect their margins? And this is where things get genuinely interesting because all three companies handled it differently. Polycab took cumulative price hikes of nearly 18 to 19% between January and March alone, aggressively passing on rising costs to the market. RR Kabel follows a dynamic pricing model. Whenever raw material prices move by even 2 to 3%, the company quickly revises selling prices so volatility gets absorbed faster through the channel. KEI, being heavily institutional and project driven, uses a code based mechanism where prices are directly linked to prevailing copper and aluminium rates at the time of the order. So, a large part of the commodity volatility simply gets passed through automatically. Same industry, same raw materials, three very different strategies. And the fact that all three are managing to protect margins despite this kind of commodity storm, that's a sign of real business strength. Now, there's one more thing worth knowing here. About 90% of Polycab's business flows through distributors and channel partners. And when copper prices start rising sharply, many dealers begin pre-stocking wires, buying in advance, expecting further price hikes. This behavior is more common in wires than cables. Wires move faster in the retail market and are easier to store. Cables are bulkier, project-driven, and much harder to stock. So sometimes quarterly sales numbers, especially in wires, can get temporarily inflated by channel stocking activity. It's not fake demand, but it's also not pure end user demand. As an investor, you need to know the difference. Now here's where the real investor signal is, the next phase. Because if there is one thing all these companies are doing simultaneously right now, it's betting big on the next phase of growth. Let's start with RR Kabel. The company is targeting nearly 16 to 18% annual volume growth. Cable capacity utilization is already above 90%, so new capacity addition isn't optional. It's necessary just to meet future demand. And they are adding it in phases, not in one big risky bet. KEI Industries openly admitted that even this quarter's growth was partly constrained by capacity limitations. Their Rajasthan plants are running at peak. The next growth phase is expected from the new Sanand facility and expanded capacity at Chinchpada. Management is guiding for 17 to 18% volume growth going forward. And then there is the market leader Polycab. A few years ago, Polycab set a bold internal target, crossed 20,000 crore in revenue by FY26 under something called their Project Leap. They didn't just hit that target, they crossed it ahead of schedule, touching over 22,000 crore. Now, they have launched the next phase called Project Spring. Under this, Polycab plans massive capex of nearly 6,000 to 8,000 crore by FY30, and it is targeting growth at almost 1.5 times the industry growth rate. The company is building capacity ahead of demand, not waiting for utilization to peak before acting. Now think about what all of this means. Three major companies are simultaneously planning thousands of crores of capacity expansion because they believe the demand coming is far bigger than what the industry has already seen. That's not just confidence, that's a signal. So what exactly are they seeing that's making them so confident? What are the growth drivers? Let's go through it. Data centers are becoming a monster demand driver. These facilities cannot afford even a 0.01% power failure, which is why they are built with multiple redundant power networks, backup systems, and massive cable intensity throughout. As AI, cloud computing, and digital infrastructure scale up in India, data centers alone could become one of the biggest demand drivers for wires and cables. Then there's defense manufacturing, renewable energy, railways and metros, EV charging infrastructure, smart cities, and power transmission networks. Every single one of these sectors needs large scale electrification. And the opportunity isn't just domestic. Large parts of the US and Europe are still running on grid infrastructure built 50 to 60 years ago. That entire network needs modernization and replacement. India's manufacturers with competitive costs and growing scale are well positioned to capture a meaningful share of that global demand. So, when you put all of this together, the growth story is not just about India building faster, it's about India becoming a global supplier of cables and wires at scale. Now, groups like Adani and Birla are suddenly aggressively entering the space. And when companies of that scale decide to enter a sector, they don't do it casually. They do it because they see a long term structural opportunity. But here's what makes their entry particularly interesting and a bit threatening for existing players. It's the raw material advantage. The Aditya Birla Group already owns Hindalco, one of India's largest aluminium producers. Adani is building Kutch Copper, a major copper manufacturing facility. And remember, copper and aluminium together account for nearly 60 to 70% of total industry costs. So, if you control your own raw material supply, you potentially have a structural cost advantage over every competitor who has to buy copper or aluminium from the open market, which means the next phase of this industry could look very different from what we have seen so far. Existing players are no longer just competing with each other, they could also be competing with some of India's biggest industrial groups with deep pockets, backward integration, and multi decade ambitions. That's a real risk, and any honest analysis of this industry has to include it. So let's step back and look at this like an investor. What's working? The industry is structurally growing, volume growth is real, major players are expanding market share, margins have dramatically improved over the years. Companies are investing confidently in massive capacity expansion, and the demand tailwinds are only getting larger. But what could go wrong? Commodity price volatility is real and can squeeze margins in the short term, as we've seen with copper, aluminium, and PVC. Channel stocking can temporarily distort quarterly numbers and create noise. And the entry of Adani and Birla brings a new competitive dynamic that could change industry economics over time. And of course, after 460%, 700 and 2000% returns in 5 years, valuations across the sectors are not cheap. The easy money may already be made. The question now is whether the next phase of earnings growth can justify current prices, and that's something every investor needs to evaluate for themselves. So here's the simple takeaway. Wires and cables were supposed to be a boring commodity business, but the organized players in this industry, backed by India's infrastructure boom, rising exports, and massive downstream demand, turned it into one of the most consistent wealth creators of the last 5 years. The next chapter is being written right now, with thousands of crores of new capacity, new demand, and new competition. Whether you're already invested or watching from the sidelines, this is an industry worth tracking very closely. Now, I want to hear from you. Which of these 3 companies do you think is best positioned for the next 5 years? Drop your answer in the comments below. We try reading every single one of them. If you found this video useful, share it with one friend who tracks markets. It genuinely helps this channel grow. And subscribe because we do deep dives like this every week. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.